In this video, I'm going to show you why Temasek's recent SATS share sale matters to your investment strategy and how you can potentially profit from understanding these institutional moves. Plus, I'll reveal SATS's ambitious $8 billion revenue target that could change everything for investors. Let's dive in. Hey friends, welcome back to the channel. I'm Iggy here, your trusted source for Singapore stock analysis and wealth building strategies. The Investing Iguana is now ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. After covering more than 500 videos and reaching 250,000 watch hours, I've developed a keen eye for institutional movements that matter to retail investors like you. Recent market activity. Let's start with the breaking news that's making waves in Singapore's investment community. Temasek Holdings has just reduced its stake in SATS through Fullerton Fund Management, selling 1.332 million shares at $4 per share, totaling $5.32 million. As of today, SATS's current stock price stands at $3.91, showing an impressive 59.44% increase over the past year. This significant price appreciation tells us something important about market sentiment, especially considering SATS's ambitious growth plans. The company has transformed dramatically since its acquisition of World Flight Services, WFS, with revenue nearly tripling from $1.76 billion to $5.15 billion. More importantly, SATS has turned around from a $26.5 million loss to achieve a profit of $56.4 million. The company's management has set an ambitious target of reaching $8 billion in revenue by 2028, representing a 60% increase from current levels. This growth trajectory requires a compound annual growth rate of more than 6% over the medium term. Trading economics forecasts suggest a target price of $3.92 by the end of this quarter, indicating market confidence in SATS's expansion strategy. The recent share sale by Temasek, when viewed in the context of these strong fundamentals and growth prospects, appears to be more about portfolio rebalancing than any lack of confidence in the company's future. Understanding Temasek's strategy. Temasek Holdings remains SATS's largest shareholder with a 39.56% stake after their recent sale of 1.332 million shares at $2.66 per share. This minimal reduction from their previous 39.68% ownership tells us something important about institutional investment behavior. Looking at SATS's ownership structure, we can see that individual retail investors collectively own about 50% of the company, while institutional investors like BlackRock, 2.2%, and Vanguard, 2.1%, hold smaller positions. Temasek's continued substantial stake suggests strong confidence in SATS's long-term prospects, especially considering their track record of maintaining strategic positions in key Singapore infrastructure companies. The timing of this sale is particularly interesting as it comes when SATS has demonstrated impressive financial performance, with revenue nearly tripling to $5.15 billion and a turnaround from a $26.5 million loss to a $56.4 million profit. This type of minor stake adjustment is typically associated with portfolio rebalancing rather than any fundamental concerns about the company's future. It's worth noting that SATS's share price has shown resilience, trading at $3.78 currently, significantly above Temasek's sale price, which further supports the view that this was a strategic portfolio decision rather than a vote of no confidence. The company's ambitious $8 billion revenue target by 2028 and successful integration of World Flight Services, WFS, suggest that Temasek's continued substantial ownership aligns with SATS's growth trajectory in the aviation services sector. SATS's ambitious growth plans. SATS has recently unveiled one of its most ambitious expansion strategies to date, aiming to boost its revenue to $8 billion by 2028. This represents a significant 60% increase from current levels, and the plan is already showing promising results. The company's transformation has been remarkable. Their revenue has nearly tripled from $1.76 billion to $5.15 billion. Largely due to the successful integration of World Flight Services, WFS. This European acquisition has proven to be a masterstroke, helping SATS turn around from a $26.5 million loss to achieve a healthy profit of $56.4 million. The company's CEO, Kerry Mock, has outlined a clear transform and perform strategy that projects an annual compound growth rate exceeding 6% over the medium term. This growth isn't just about numbers. SATS has strategically positioned itself as a global cargo leader with diversified exposure across multiple regions. The company's expansion plan is built on 5 key strategic priorities: revenue growth, operational efficiency, portfolio optimization, debt management, and shareholder value creation. They've already demonstrated their commitment to these goals by declaring a dividend of 1.5 cents per share, marking their return to rewarding shareholders while maintaining focus on growth investments. Industry analysts, including those from CGS International and DBS, have noted that while these targets are ambitious, SATS's newfound capabilities and global presence make them achievable, particularly given the company's strong performance in managing costs and enhancing profitability. The company has also strengthened its position in key markets, including opening its largest international food solutions facility in Bengaluru, India, showing its commitment to expanding its global footprint beyond its traditional Singapore base. Integration of World Flight Services. The integration of World Flight Services, WFS, has proven to be a game-changing move for SATS, showcasing remarkable financial results that have exceeded market expectations. Since completing the 1.8 billion Singapore dollar acquisition in April 2023, SATS has demonstrated exceptional execution in merging operations. The numbers tell a compelling story. Revenue has surged nearly threefold from 1.76 billion Singapore dollars to a record 5.15 billion Singapore dollars, while the company has successfully transformed its bottom line from a 26.5 million Singapore dollar loss to a healthy 56.4 million Singapore dollar profit. The integration is progressing ahead of schedule, already delivering 40 million Singapore dollars in annual EBITDA synergies out of the targeted 100 million Singapore dollars. This success has been driven by multiple factors, including increased market share, network optimization, and cost efficiencies. The acquisition has also significantly diversified SATS's revenue streams, with air cargo handling volumes now at 429% of pre-pandemic levels compared to the standalone 93%. This strategic expansion has transformed SATS from a primarily Singapore-focused operator into a global aviation services leader, providing crucial protection against regional market fluctuations. The company's EBITDA margins have improved substantially to 17.3% from 9.9%, reflecting enhanced operational efficiency and stronger pricing power. Looking ahead, SATS has set an ambitious target of reaching 8 billion Singapore dollars in revenue by 2028, with the WFS integration serving as a cornerstone of this growth strategy. The company has also resumed dividend payments with a 1.5 cents per share payout, signaling management's confidence in sustained financial performance. Innovation and technology integration. SATS is making significant strides in technological innovation at Changi Airport. In a groundbreaking collaboration with SIA Engineering and Changi Airport Group, they're launching autonomous buses to transport airport staff around the airside areas. This 2-year pilot program, scheduled to begin in the third quarter of 2024, represents a major step toward automating routine operations. The project, co-funded by the Civil Aviation Authority of Singapore's Aviation Development Fund, will roll out in 2 careful phases. First, they'll test the buses in a controlled environment, followed by trials in live operational settings. Safety remains paramount, with each autonomous bus having an onboard safety driver during the trial period. This initiative goes beyond mere transportation. It's part of a broader strategy to transform Changi Airport's operations. The project aims to free up skilled workers from routine driving tasks, allowing them to focus on more complex responsibilities. It's particularly significant because SATS and its partners are also testing similar autonomous solutions in Europe, including automated cargo transportation vehicles and forklifts. This comprehensive approach to automation could revolutionize airport operations, potentially reducing congestion, improving safety, and increasing overall efficiency. The project aligns perfectly with Singapore's Smart Nation vision and demonstrates SATS's commitment to leading technological advancement in the aviation sector. Financial health and market position. SATS has shown remarkable market performance, with its stock price currently standing at $3.97, representing a significant 59.44% increase over the past year. Recent trading data shows positive momentum, with a 0.76% daily gain and a robust 6.15% increase over the past month. Looking at analyst forecasts, Trading Economics projects a target price of $3.92 by the end of this quarter, while the broader analyst consensus is more optimistic, with an average 1-year price target of $4.06, ranging from $3.18 to $4.62. The company's financial health has strengthened considerably, particularly following the WFS acquisition. Revenue has nearly tripled from $1.76 billion to $5.15 billion, and the company successfully turned around from a $26.5 million loss to achieve a $56.4 million profit. This transformation demonstrates SATS's effective execution of its growth strategy. The company has set an ambitious target of reaching $8 billion in revenue by 2028, representing a 60% increase from current levels, with a projected annual compound growth rate exceeding 6%. Strategic priorities. Management's 3 rupees strategy, repaying loans, reinvesting in capital expenditure, and resuming dividends, has already shown results with the declaration of a 1.5 cents per share dividend. While this represents a more conservative approach compared to their previous 70 to 80% dividend payout policy, it reflects a balanced approach to growth and shareholder returns. The company's focus on debt management and strategic reinvestment positions it well for sustainable long-term growth, particularly as global aviation continues its recovery trajectory. Market outlook. Pivotal moment in its growth journey. The company has demonstrated remarkable resilience, swinging from a $26.5 million loss to a profit of $56.4 million in the latest financial year. This turnaround isn't just about numbers, it's backed by solid operational improvements and strategic expansion. The WFS acquisition has transformed SATS into a global player, nearly tripling its revenue from $1.76 billion to $5.15 billion. Their ambitious target of reaching $8 billion in revenue by 2028 represents a 60% increase from current levels, supported by a clear transform and perform strategy. The aviation sector's recovery continues to gain momentum, with global air passenger traffic expected to fully recover to pre-pandemic levels by the end of 2024. Air cargo traffic is projected to grow by 4.5% in 2024, providing SATS with strong tailwinds. The company now operates in strategic locations, including 5 of the top 10 cargo airports in North America and Europe, and 4 of the top 10 in Asia. This expanded network covers trade routes responsible for more than 50% of global air cargo volume. SATS's management has outlined a practical approach to growth through their 3 rupees strategy: repaying loans, reinvesting in capital expenditure, and resuming dividends. Looking ahead, the company's focus on debt reduction, cash optimization, and sustainable growth, combined with positive industry trends in e-commerce and specialized services, suggests a promising outlook. However, investors should note that success will depend on effective execution of their expansion plans and management of industry cyclicality. If you found value in this analysis of Temasek SATS transaction, you're going to love my video SGX Game Changer, Trade Alibaba and AMP, BYD and SGD. In that video, I break down how you can now invest in these Chinese tech giants directly through SGX using Singapore dollars, potentially saving on currency conversion fees and simplifying your investment process. Plus, I share some exclusive insights on why these new listings could be a game changer for Singapore investors. Click the link above or check out the end screen to watch it now. Don't forget to hit that like button and subscribe to stay updated on more Singapore investment opportunities. See you in the next video.